everyone, it's Caroline here from the Juniper Links accounting channel, and today we're going to go over how to pay yourself in salary and dividends from your own company. So I've gone through a couple of examples of how you can run and set up salary, as well as the profit calculation and how you can take out dividends from your company. So there's a lot of information in this video, so be sure to stick to the very end. And without further delay, let's get started. Alright, let's get started with the video. So this one is going to basically explain a little bit further how to pay yourself in salary and dividends from your own limited company. Okay, so technically there are three ways to pay yourself. The first one is salary. So I'm sure you've heard of salary before, but if you're a director and an employee, you can receive a salary from your own limited company. The second way to pay yourself is in dividends. So if you're a shareholder of a company, then you receive dividends from company profits, and you can choose how much to pay yourself with these dividends, depending on the level of profit that is available in the company, which I'll show you how to calculate that further in the video. And obviously, if you're the sole director, employee, and shareholder of your own company, then you're entitled to all of the profits. If you had a husband and wife company, or you're running a company with a partner involved and they have 50% of the shares, so let's say you each have £1 in the business, that means all the profits in the company will be split 50-50, and you also have 50-50 ownership. So whenever you take a dividend, they'll also need to receive an equal amount of dividends to yours. And the final way to pay yourself is through expenses. Now, this one sounds a bit weird, I know, but basically a director and employee can receive certain expense reimbursements. So, for example, there's something called the use of home allowance that a director has access to, which basically reimburses the cost or part of the cost of working from home. And this is an unreceipted allowance, so there's no need to evidence the claim to HMRC other than the fact that you do carry out business from home. So let's go into paying a salary first, and this is done through something called PAYE, otherwise known as pay as you earn. And all you need to do, the submissions, is a payroll software. So for example, we use FreeAgent, and within FreeAgent we have the ability to submit these PAYE RTI submissions, they're called, so real-time information, to HMRC through that software. And all we have to do is set up the correct amount of salary we want to run for the year and all the employee details, obviously, and that can be submitted each month to HMRC, who will receive the information and understand this is how much this employee is being paid and this is the appropriate taxes for that period, and if there is a tax liability, then your company will pay that over to HMRC. So the first thing you want to work out is how many people will you be employing, because this will definitely change the way your company is taxed for national insurance, and potentially how much you can pay yourself and still be tax efficient. So as a single director salary, you would normally run a salary somewhere between the national insurance threshold and personal allowance to stay tax efficient. So the national insurance threshold is the point at which your company or yourself starts paying national insurance on salary. And there's normally a certain amount before this happens. So obviously, if you don't pay yourself much more above an NI threshold, then you won't have a very big national insurance bill for the year. But you'll still get a qualifying year for state pension and all the other benefits that come with that. The other one is personal allowance. Everyone pretty much is entitled to a personal allowance unless they've got a certain amount of income. So for example, once you start earning over 100k, you start to lose your personal allowance. But everyone's entitled to this to start with, and it's currently £12,500 for the year, and this is the amount you can receive as income before any personal tax is paid on salary. So, or any other income, to be honest, because for example, if you don't use your whole personal allowance on your salary and you receive dividends, let's say, you can use the remaining personal allowance on your dividends to make those tax-free as well. So normally between these two thresholds is a pretty good way to stay tax efficient. It's kind of up to you how much you pay yourself within that. With two directors, you can start to do some more interesting things because you can actually run both salaries up to the personal allowance, and your company can claim something called the employment allowance. And this employment allowance basically gives you a threshold before your company needs to pay any employer's national insurance. So if you run salary up to the £12,500 personal allowance, there won't be any tax and you'll just have to pay employees' national insurance. So when you have the 2 directors and 2 employees, for example, in a husband and wife company, you can be a little bit more tax efficient in this way. And yeah, you'll pay the employees' national insurance, but the savings to the employer's national insurance and the savings to corporation tax, because salary is an allowable expense, because of all those things, it still makes it worthwhile. So remember that regular employees earning over £10,000 in salary for the year will need to be added to auto-enrollment. So your company will need to set up an auto-enrollment pension scheme, basically, for those employees to be automatically enrolled, and they can later opt out if they want to. And generally, it's more tax efficient to just set up your own private pension scheme that your company can pay into on your behalf, rather than doing it through auto-enrollment. Okay, moving on to paying dividends. So company shareholders, like I said before, can receive dividends from the available profit. So these can only be taken when there's leftover profit after tax. And this is what I mean by available profit. So it has to be after all company liabilities have been taken into account, and whatever's left over is then eligible to be declared as a dividend. And if you do take dividends while there isn't enough profit available in the company, and let's say it wasn't able to pay its corporation tax or its VAT bill, then you could be held personally responsible for the fact your company wasn't able to afford those things because you took out dividends when you shouldn't have. And HMRC can come after you personally in those circumstances, so it's best to just not ever do that if you can help it. So illegal dividends automatically create a director's loan. And something that they've added for directors' loans is a corporation tax deposit of 32.5%. So if there are outstanding loans at the company or end state, and these are not repaid by the corporation tax deadline, HMRC will want another 32.5% deposit on the outstanding loan value. So this is basically, you can see this is higher rate dividend tax right here, and it's basically to stop people avoiding to pay tax bills through taking loans out from their company rather than declaring them as dividends. So obviously this creates problems where if you're legitimately taking a loan from your company and actually set up a proper repayment plan and everything like that, then you're kind of in a bad place because you can't do that anymore. And finally, we've got expense reimbursements. So employees can receive repayments for certain business expenses. So for example, mileage to a temporary place of work, accommodation that they needed to buy to access a temporary place of work, or business trips and so on. Same with meals while they're traveling on business. And also things like the use of home allowance, which is just something given to directors to help with costs while they're working from home without having to actually come up with their own calculation. And this allowance here is changing. From April 2020, it's going to be £6 per week. So it's a £2 per week increase, which is nice. I believe that saves about £96, or that lets you take out about £96 more a year from your company as an expense, and obviously your company will get corporation tax relief on that, so the savings is a bit better than that £96, but anyway, it's helpful. So on these business expenses, your company of course gets corporation tax relief, and you can be repaid from the business account for these, so you're technically being able to take out this money from the company without it being income. So for example, if you're going to through an umbrella company, then none of these costs would be claimable. You would get your net pay after all tax and national insurance has been deducted, and then from that you would have to pay for all of these costs. You essentially get the same effect if these costs were paid for directly with the business account, but for certain things such as the use of home allowance and mileage claims, they are impossible to pay for directly with your business card because they're not something you buy and then reclaim from the business. And that's kind of generally what the expense reimbursements are, and definitely add them to your accounts if you are doing legitimate travel on behalf of your business, because it's going to save you the tax money, and you can also get that money out without having to have first paid for your personal taxes, which is not so great. now we are moving on to working out company profit. And this is basically what we need to do in order to work out how many dividends you can pay yourself at any given time. And luckily we have software to do this now, but I'm going to do a breakdown of how it works so you can see kind of the impact that it has. So let's say your company has £50,000 in turnover, and I'm just going to say that's net of VAT. So that's already been taken out as something you need to pay over to HMRC. We're not counting that in there. I'm just leaving VAT out of this calculation for simplicity's sake. So firstly, we've got £10,000 worth of expenses. So these are things like tools, travel, equipment for the company, software costs, anything you need for the business in order to operate and hopefully make profit. So advertising as well will go in here, just running costs of your business. And then we've got a salary. In this case, I'm doing the example as a single director salary with the intention of this being for the 2020 to 2021 tax year. And that's going to sound really confusing. Basically, the tax year starting 6th of April 2020. This will be the new tax efficient salary for a single director. Then we've got £98 of employer's national insurance to take away from this. This is a valid company expense. And again, it's not something that's deducted from your own salary because it's the employer's responsibility. The employer's national insurance threshold for next year, or the upcoming year starting April 2020, is going to be £8,788, which is less than the employee's national insurance threshold, which is why we don't have any employees here, but it wouldn't be added into here anyway because that's all with personal tax. And right now we're looking at only company profit. So it's nothing to do with personal tax just yet. And then we've got the use of home allowance, which is the £6 per week. Then we have our profit figure. So this is simply this 50k turnover minus all of these costs to the company. And we've got our operating profit here. The next step is to take away corporation tax. This needs to be paid over to HMRC once a year. And in this case, it's 19%, which is the 5.7k there. And finally, we've got our profit figure for dividends. So this is the leftover amount after corporation tax has been deducted from the operating profit. So this £24,373 is technically money we could take as dividends for ourselves as the shareholder of the company. So again, this is just the company side of things. We have to do a separate calculation for your personal tax. So now that we've done that, we can see we've got this 24k available as profit, and in our personal tax calculation, we're going to go with the assumption that you're just going to take out the entire £24,000 from the business as dividends. Let us start working out our take-home pay. Like we saw before, we had the £9,500 salary, and we have this £24,373 in dividends. So the total income for the year is £33,873. And from that, we're going to deduct the personal allowance for the year, which is tax-free. So like I said, most people will have a personal allowance unless you're earning over a certain amount of money, or for some reason you had an underpayment from a previous year and HMRC has adjusted your tax code, which means you've got less of a personal allowance for this year. Or if you had a marriage allowance transfer, for example, then you would obviously, whether you were receiving it or giving it, would change your personal allowance for the year. So all of those things need to be taken into account. But in this case, we're just doing a very standard, straightforward case of personal allowance at £12,500. This means £21,373 of this income is taxable. Now, because we took away the £12,500 personal allowance, and this is greater than the salary, that means this whole entire amount here remaining at the end is actually dividends. So there's a hierarchy of things that are being added when you decide what is being taxed first. And it's always going to be the salary first, and similar types of income such as self-employment income, pension income, all of those will be added together first, and then the dividends will come later. So the next step, since we have established that this entire 21,000 is in fact dividends, or are in fact dividends, then the next step is to take away the dividend allowance for the year, which is £2,000. And this is also a tax-free value which you can benefit from. So what we've got left is £19,373 as the actual taxable amount for dividend tax. And dividend tax in the lower rate threshold, so under £50,000 of income, will be 7.5%. The total figure here of £1,453. Okay, so now we've finally worked out the dividend tax on your income. On the right side here, we'll be looking at your actual take-home pay, finally. We're finally getting there. Okay, so £9,500 in salary. Then, of course, you've got your dividends that you've actually taken, so that's £24,000. And I'm adding in the use of home allowance here because it's something you wouldn't have received otherwise. And this is basically extra income you can receive from your company to go towards your home working costs. And then we take away that dividend tax bill, which is payable once a year on your self-assessment. In some cases, such as this one, if it's over £1,000, there will be something called a payment on account due, which I'll actually explain a little bit further in the video. So the total take-home pay in this calculation is £32,732 from that initial £50,000. And the thing we want to keep in mind here is that your company was able to pay for all of those expenses. So let's say you're going through umbrella companies and they obviously don't allow you to claim those expenses, and the employer isn't going to do it for you either. So in theory, you have also been able to receive this £10,000. It's not technically your money, but you've also been able to spend this £10,000 without having to pay tax on it personally. So it's a huge advantage over something like an umbrella company. As for actually taking money out of the business, so salary is done through something called PAYE, like I said before, and this is a case of making those monthly submissions to HMRC for the amount of salary you want to run for yourself. And you would also set up a direct transfer to yourself every time you pay yourself a salary, or report that there was salary paid to HMRC. So the easiest way to do this is to set up a standing order to yourself, which just automatically pays out the money, or you can just do it manually, either way. So for dividends, again, it's simply a case of setting up a transfer to yourself from the business account and labeling it as a dividend. And ideally, you would want to take them out quarterly if you can, but you can also take out monthly dividends. Just make sure that they're clearly labeled and set up in a separate transfer from your salary payment, because you definitely don't want those to be confused with each other.